The Fed's Financial Stability Report is a periodic publication that summarizes the Federal Reserve Board's assessment of the resilience of the U.S. financial system and the potential risks to its stability. The report is based on a framework that identifies four main vulnerabilities: asset valuations, borrowing by businesses and households, leverage in the financial sector, and funding risks. The report also discusses near-term risks that could pose challenges to the financial system in the short run. The latest report, released in May 2023, highlighted some of the lingering effects of the bank rescue that took place in March 2023, when several prominent mid-sized banks, including Silicon Valley Bank, faced a sudden run on their deposits and had to be bailed out by the Federal Deposit Insurance Corporation, FDIC, and the Federal Reserve. The rescue was successful in preventing a wider systemic crisis, but it also exposed some weaknesses in the regulatory framework and the market discipline of the banking sector. According to the report, one of the main sources of vulnerability for the financial system is the elevated valuation of some asset classes, such as stocks, corporate bonds, and commercial real estate. These valuations reflect the low interest rate environment, the strong economic recovery, and the optimistic investor sentiment. However, they also imply that asset prices are sensitive to changes in interest rates, economic outlook, or risk appetite. A sharp correction in asset prices could trigger losses for investors and lenders, and potentially impair the functioning of some markets. Another source of vulnerability is the high level of debt among non-financial businesses and households. The report noted that business debt has increased significantly since the onset of the pandemic, reaching a record high of 84% of GDP by the end of 2022. While most businesses have been able to service their debt thanks to the low interest rates and the fiscal support, some sectors, such as hospitality and entertainment, have seen their revenues decline sharply and their leverage ratios rise. A deterioration in business credit quality could lead to defaults, bankruptcies, and losses for creditors. Household debt has also increased during the pandemic, mainly driven by mortgage borrowing. The report observed that household debt service burdens have remained low due to the low interest rates and the income support programs. However, some households may face difficulties in repaying their debts if interest rates rise or income support expires. A rise in delinquencies and foreclosures could have negative effects on consumer spending and housing market activity. The report also assessed the leverage and liquidity positions of the financial sector, which plays a crucial role in intermediating credit and facilitating payments in the economy. The report found that most financial institutions have maintained adequate capital and liquidity buffers to withstand potential shocks. However, it also pointed out some areas of concern, such as the exposure of some banks to commercial real estate debt, which has experienced a decline in quality and value due to the pandemic. The report also noted that some non-bank financial intermediaries, such as private credit funds and money market funds, have increased their leverage and maturity transformation activities, which could pose risks to financial stability if they face funding pressures or redemption requests. Finally, the report discussed some near-term risks that could affect the financial system in the short run. These include the transition from LIBOR to SOFR as a reference rate for various financial contracts. The report warned that some market participants may not be prepared for this transition, which could create operational and legal challenges. The cyber attacks on critical infrastructure and financial institutions. The report emphasized that cyber attacks could disrupt the functioning of payment systems, compromise confidential information, and erode public trust in the financial system. The spillovers from stress abroad to the U.S. financial system. The report highlighted that some foreign economies are facing challenges from the pandemic, geopolitical tensions, or domestic political instability. These challenges could affect U.S. financial institutions and markets through trade linkages, direct exposures, or contagion effects. The recent collapse of Silicon Valley Bank and Signature Bank sent shockwaves across the financial system and revealed the fragility of some mid-sized banks that had grown rapidly in recent years. These banks had attracted customers with high interest rates and generous perks, but they also relied heavily on uninsured deposits that could flee at any sign of trouble. Unlike insured deposits, which are backed by the Federal Deposit Insurance Corporation, FDIC, up to $250,000 per account, uninsured deposits are not guaranteed and can be subject to losses if a bank fails. These banks also had poor risk management practices and did not adequately prepare for the possibility of rising interest rates. As the Federal Reserve began to tighten monetary policy in response to persistent inflation, these banks faced higher costs of funding and lower profitability. They also had exposure to risky assets, such as commercial real estate loans and technology stocks, that suffered losses as the economy slowed down and market volatility increased. When these banks reported disappointing earnings and deposit outflows in March 2023, they triggered a panic among their customers and creditors, who rushed to withdraw their money or demand repayment. This created a liquidity crisis that quickly spiraled out of control and forced the banks to seek emergency assistance from the Fed and other regulators. However, the rescue efforts were not enough to save them from insolvency, and they were eventually taken over by the FDIC. The failure of these banks had significant spillover effects on the rest of the financial system and the economy. It eroded confidence in other mid-sized banks that had similar business models and funding sources. It also disrupted the flow of credit to many businesses and households that relied on these banks for loans and services. Moreover, it raised questions about the adequacy of the regulatory framework and supervision for these banks, which had grown too big to fail but too small to save. The Fed's report on bank rescue, released in May 2023, highlighted the risks posed by these banks to financial stability and recommended several measures to address them. These include strengthening capital and liquidity requirements, enhancing risk management and governance standards, improving resolution planning and coordination, and increasing transparency and disclosure. The report also emphasized the need for continued vigilance and monitoring of the financial system, especially in light of other potential sources of stress, such as money market funds, stablecoins, and hedge funds. The Fed intervened with several emergency funding measures to stabilize the system and limit the potential for further stress. One of the most significant actions that the Fed took was to cut interest rates effectively to zero on March 15, 2020. This was intended to lower the cost of borrowing and stimulate economic activity. The Fed also announced a $700 billion round of quantitative easing, which involved buying Treasury securities and mortgage-backed securities to support the smooth functioning of these markets. Another major step that the Fed took was to create or expand multiple emergency lending facilities under its Section 13(3) authority. These facilities were designed to provide credit to various sectors of the economy that were affected by the pandemic, such as small and medium-sized businesses, money market mutual funds, consumer lending, and corporate and municipal borrowing. Some of these facilities were created jointly with the U.S. Treasury, which allocated up to $454 billion from the CARES Act to support the Fed's lending resources and absorb potential losses from defaults on emergency loans. The Fed also coordinated with other federal agencies and international central banks to enhance the provision of liquidity and support global financial stability. For example, the Fed established swap lines with 14 foreign central banks to facilitate the availability of U.S. dollars abroad. The Fed also worked with the Treasury, the Federal Deposit Insurance Corporation, FDIC, and other regulators to ease capital and liquidity requirements for banks and encourage them to lend to households and businesses. These emergency funding measures were unprecedented in their scale and scope, and they helped to prevent a deeper financial crisis and mitigate the economic impact of the pandemic. However, they also raised some challenges and questions about the Fed's role, accountability, and independence in times of crisis.